a lot of the data that we're looking at in terms of trying to find out what's going on with the trade war is sort of more, data that we typically don't look at. As an example, if you look at outbound containers from China to the US, that number is sinking like a stone. It's sinking like a stone, which would argue that people don't yet, the only thing we're dealing with respect to the trade war right now is the uncertainty around trade. It's not the effect of the tariffs per se. That's coming because obviously there's this thing called the Pacific Ocean, and it takes time for things to move from one place to the next. But you're going to have at some point like a story about, shelves not being stocked. Why do you think it is that these CEOs of major retailers were in the White House this week? Probably because they're saying pretty dire things to the president, like, hey, man, like if you keep this up, I don't know, maybe we won't have a Christmas this year.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
Welcome to RenMac Off Script. We openly discuss markets, economics, policy, history, and life. It's the 25th of April, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
All the charts that we reference are posted to our Twitter account and our LinkedIn account. And if you want to subscribe, be a RenMac Access subscriber for those who are investing their own dollars, not the institutional side of the business, where we obviously actively engage on a daily basis. A lot of stuff going on this week, a lot of it being focused on the economy. It seems that Chair Powell is keeping his job for now, but who wants to go first? I'm out here in sunny California, but who wants to go first?
Sorry.
Neil, you're up.
I've always found people that say the weather in California is amazing. I find that argument highly overrated. I bet you it's warmer here in New Jersey than it is over there. And it's also clear blue skies.
In New Jersey.
In New Jersey.
With no drones?
No drones.
Much cheaper gas. I'll tell you that. Gas is like $5.30 here. It's unbelievable.
Cheaper gas.
Bruce Springsteen.
Fewer hippies.
Well, got that. I am at Stagecoach, so this is not really the hippie fest, but we'll see. Should be a good lineup. Anyway, let's get into the economy. What's going on this week? Powell kept his job, at least for the time being.
He's keeping his job. It's sort of, come on. That's sort of, now apparently he never even thought about doing it. So look, it's the sort of classic Trump, like the bond market is beautiful. Oh no, now there's reports of him saying the bond market wasn't even the reason why he paused the reciprocal tariff thing, right? Like, so it's sort of the, it's the heads I win, tails you lose kind of thing. I never really thought that Powell's job was in jeopardy. And frankly, as I've been arguing, a move like that would actually backfire on Trump spectacularly because it would invite additional scrutiny to whoever he picks. Frankly, I think the genie's out of the bottle in that sense anyway. I think at this point, given what he's been saying about the Fed, whoever he does nominate will have a lot more scrutiny on him. And while I thought that firing Powell was a very low probability event, I think nominating Kevin Warsh in his place is actually worse because this is someone who's been hawkish for as long as I've been in the business. All he knows how to do is bash the Fed at every turn. If he takes the job, which is frankly a job he's wanted forever, you have to assume that he's doing it under the pretense, at least from Trump's perspective, that he'd be giving up his decades of consistent hawkishness. Remember, the one reliable thing about Kevin Warsh is that when he's wrong, he's always wrong in the same direction. That's the last thing you want in a central banker. So, and look, I think the economy evolves in ways that you may not understand right now, or you may not expect right now, and that erodes political standing in ways you may not appreciate. So maybe Trump's political position is strong. God knows what it'll be 6 months from now, after potentially the economy is a lot slower or unemployment is somewhat higher, and he may be forced at that point to put into place a more consensus pick, like maybe say Governor Waller. And also keep in mind, I mean, the sort of interesting wrinkle in all this is Jerome Powell himself, because while his tenure as chair is over next year, he still has an additional governor, so he doesn't actually have to go anywhere. So interesting stuff. Obviously the trade issues are much more, kind of salient at the moment. But as I mentioned, Jeff, I mean, I never really thought it was a big risk. He shouldn't really be talking about it. But that's kind of where I'm at with the Fed.
I'm a little surprised that the dollar wasn't stronger with this move in equities. Dollars oversold, certainly had a bounce, but not anything that I would have, certainly not as strong or as fierce as I would have expected, given the reaction function that we saw in equities.
Well, maybe people are realizing that on a relative basis, growth is exiting the U.S. and going everywhere else.
So what was the data this week? As you went through and looked at the data, what was the salient data that was out this week from?
I mean, to me, it's just the big story is just resolving this tension between survey-based measures of economic activity and actual measures of economic activity, right? Surveys, in my opinion, as a business economist, are useful in refining your forecast. So if you get a big drop in capital spending intentions, don't be surprised if you see a big drop in core durable goods shipments at some point. And so we saw that in the Richmond Fed manufacturing PMI. CapEx intentions are down. We see it in the Kansas City PMI. CapEx intentions are down. If you look at single family new home sales, home sales were up, but we also know that completed unsold inventory continues to rise, which is probably one reason why one of the ways they're getting the product out is by cutting prices. I mean, so it's a margin squeeze for home builders. And this is happening at a time when we know in April interest rates backed up, which will probably weigh on housing demand. And oh, by the way, that's coming through in some of the public builder commentary. A lot of the data that we're looking at in terms of trying to find out what's going on with the trade war is sort of more, data that we typically don't look at. As an example, if you look at outbound containers from China to the US, that number is sinking like a stone. It's sinking like a stone, which would argue that people don't yet, the only thing we're dealing with respect to the trade war right now is the uncertainty around trade. It's not the effect of the tariffs per se. That's coming because obviously there's this thing called the Pacific Ocean, and it takes time for things to move from one place to the next. But you're going to have at some point like a story about, shelves not being stocked. I mean, why do you think it is that these CEOs of major retailers were in the White House this week? Probably because they're saying pretty dire things to the president, like, hey, man, like if you keep this up, I don't know, maybe we won't have a Christmas this year. It's stuff like that. So I think, there's a lot of noise right now. I mean, the press reports are very conflicting. Like, I'm talking to China. No, the Chinese embassy is saying we're not talking. We're doing deals with all these countries. Are they really deals, or are they sort of IOU deals, right? Deals to do deals later under the pretense of just continuing the pause in the reciprocal tariffs, which just really just keeps the uncertainty going. So there's a lot of noise right now. I just think it's important for people to just focus on what's actually happening. And what we actually have is a 10% baseline tariff and a trade embargo with our largest trading partner. That's what's good. That's right now, today. That's right. I think news headlines can kind of get you off the mat, but are they going to kind of keep things going? I mean, to me, that really remains to be seen.
So, Steve, in terms of who's talking, who's not talking, what's the latest there?
Well, I mean, I think Neil pointed out it's difficult to sort of get what the ground truth is. President Trump saying that the sides are talking, China obviously denying that. Could be at the lower levels. And the encouraging thing is that talking is better than not talking. And my guess is at least some lower level, whether they're official or not, their conversations, because again, mutually sort of assured economic disruption at a minimum right now because of the triple digit tariff levels on both sides. So I think there's an appetite to bring them down on both sides. I think the more challenging piece is going to be trying to form some durable trade deal between the both sides, the U.S. and China. After that, there's a lot of mistrust on the U.S. side now that China didn't honor their obligations from the phase one deal the last time, asking for a lot of structural changes that I just don't see the Chinese willing to do in terms of using a state-based economy to issue a lot of subsidies and whatnot. So I think it's going to be difficult to see what that off-ramp is, the eventual off-ramp. I think it's really going to also depend on a lot of the diplomatic battleground that we've been talking about with both China and the U.S. trying to pull third-party countries into their sphere of influence. And I think that sort of touches on, from Neil's standpoint, what does Trump need for the off-ramp? For these reciprocal tariffs. I think it's clear that you sort of see right now is maybe we've passed the point of peak tariff. Now all the conversations are really about pulling tariff back, extending the pause, looking for exemptions from certain companies. And so I think, moving forward, that's probably encouraging. But is the U.S. just looking to boost exports and get foreign direct investment? Or is part of the conversation going to be getting these other countries to take a stronger approach to China, impose some of their tariffs there, prevent China from rerouting their products through there? If it's the latter, that's going to be a more difficult conversation. And I think that impacts the eventual conversation with China. And so I think to Neil's point, that's where you're probably looking at a period of prolonged uncertainty, if nothing else, which is obviously a very difficult environment to deploy capital. And I think that going back to where we began the conversation with Fed Chair Jerome Powell, I think that was sort of ultimately what came to light is you don't need additional uncertainty on top of what is already a very uncertain environment.
Yeah, chaos certainly reigning the day, and not helpful from an equity market or a bond market perspective, for that matter. 5,500 really the key level on the S&P. Getting through that is that April 9th rally. Certainly helps push things up towards that 5,800 level, which will be important in our view. Neil, what are as you're looking at this and surveying it from the economic standpoint, what are the key, maybe one or two indicators as we go forward from here to, ascertain not only where we're going, but kind of the magnitude of the deterioration that you think is in the cards at some point?
Yeah, so I think I've been very clear that I think it's kind of right here, right now. I think the economy was already slowing, and whatever's going on right now is making a bad situation worse. I would say that there are three things that people need to keep an eye on, and this goes back to the point I made about reconciling survey-based measures of data with actual data. So the first would be investment, and if you look at business investment expectations, there was a improvement immediately following the election, and that has since collapsed. It's gone, not only round trip, but gone well beyond that. We're well below normal with respect to business investment intentions. At some point, you'd expect that to bleed into actual business investment. It's hard for companies to invest in this situation, not only because of the rug pull effect, right? We went into the year with very strong expectations for growth relatively, and we have cut those expectations dramatically. So what drives investment tends to be an accelerator effect. So if people think growth will slow, they'll tend to invest less right now. And then you layer on the uncertainty shock, and that kind of what pushes it even down even more. The next thing would be housing. So builder sentiment's been slowing, and I'd expect that to bleed into new home sales. I think for everyone else, the fact is that prices in the resale market are slowing too, right? Because inventories are rising. And, if people start to think that the price of their home is not as strong as it was before, that might be a reason for people to save a little more. Your net worth is going down relative to your income. And the last, and frankly, the most obvious is employment. Why would hiring rates be picking up right now? I mean, this is not like an area where you can, pull forward activity. And, it's not like, I mean, maybe you can with hours, I suppose, but hiring is sort of a decision that's much harder to reverse. So when uncertainty is high, you'll be more likely to delay that decision than not. And so, to me, that basically means weak hiring rates. You start to see some, signs that layoffs might be picking up. I mean, that's already kind of been happening. It's in train. And so to me, that kind of sets the table for potentially, some very sluggish employment numbers over the next several months. And that, I think, should push up the unemployment rate and bring the Fed into the equation. So that's kind of how I'm seeing it. So I think it would be three things: investment, housing, and jobs.
Yeah. And you're still on the June cut?
I mean, I think June's I think they'll go 4 times this year. I think June is like a 50-50 bet. I mean, if the next jobs number is weak, then, we'll probably be talking about June. But I think July is quite likely.
And Steve, what's going on in terms of Washington beyond tariffs and beyond Powell?
Beyond those things, which are two pretty big things, Congress does return next week, and I think we're going to be at the point now where Republican lawmakers, the rubber's going to need to meet the road, because the following week it's a non-binding date, but that's when the respective committees need to submit their portions for the reconciliation package. And you still have very significant differences with House Republicans that want to candidly spend less and maybe tax less, more concerned with the deficit, and Senate Republicans that don't want to touch spending as much and a little more comfortable with the deficit financed approach with the current policy baseline instructions in their reconciliation package. So it sounds weedy. Basically, I would watch what is going to happen with Medicaid. That is something that is particularly concerning for a number of moderate Republicans that don't want to really see their constituents impacted by that. But it's really difficult to get to the spending numbers outlined in the instructions if you don't make some adjustments there. So I think that's one area to watch. The other area to watch is on the tax cut side. It's going to cost a lot under traditional scoring methods to just get a clean extension of the expiring provisions for this year. And if anything beyond that, it's obviously going to add more to the deficit. So I think that's really the thing to watch. And just big picture, you talk about Trump 1, you had actual tax cuts providing a tailwind. This time, you're really trying to prevent a headwind of tax increases, in my opinion, from taking place if Republicans don't pass it by the real deadline, which is the end of this year. The other thing that you're probably going to get this week, a little earlier than originally announced, is we may get this X-date estimate from the Treasury Department of when the government will exhaust its ability to honor its obligations. Again, this is tied to the reconciliation effort. So if that date is sooner, that's going to put, or maybe meant to put, pressure on Republican lawmakers to resolve the differences and act sooner. If not, that will have to be done through a separate package. It's likely going to require Democratic votes. My guess is Republicans would try to attach that to some disaster aid bill and sort of dare California Democrats in particular to vote against it.
Yeah. Fascinating. We're going to go to the mailbag. Harry, what is on the mailbag? What is that? My God.
Did Drew Carey and Jeff DeGraff have a baby?
Oh my God, that is disgusting.
I think it's a very Jeff compromise.
Holy cow. Harry, what's the question this week? Get that off the screen, for God's sakes.
Okay. We have a question from Andrew Davis this week. What's your go-to indicators when it comes to making a tactical call on bonds? That's it. Thank you.
What is the go-to indicator when making a technical call on bonds? Well, I think one of the things that we do that's unique is we look at the world from what we call a conditional aspect. You can almost think of Neil's world as those conditions, kind of what's happening. Valuation to us is a conditional factor. Is valuation supportive? Is it not supportive? One of the better conditional factors for us when it comes to bonds is our market cycle clock. And so when our market cycle clock is in this zone generally, which is that bottom left zone. Clients will know what we're talking about. Then that tends to put downward pressure on rates. And so we will look at the conditional factors and then obviously skew that more towards trend around there. So when we get overbought conditions in downtrends, when we've got the conditional factors of our market cycle clock in a favorable spot, that becomes pretty bullish for us. Right now, it's a little bit more of a mixed bag. There's not really a clearly definable trend for yields. You'd have to get through roughly 480 to put that trend to the upside. You'd have to get down through basically 413, 4% to get the trends down to the downside. So right now it's in this kind of middling zone. And in fact, in our market cycle clock officially, well, it's a little bit more supportive for the bonds and lower yields. It's not overwhelmingly so. So a much tougher call on bonds here from our standpoint. Neil, anything from the economic side that tends to be go-to for you when it comes to making a bond market call?
Well, I mean, for me, it's if you think the economy is slowing down, you want to be long bonds. If you think the economy is speeding up, you want to be short fixed income. I do think, I think a lot of the sort of anxiety around the fixed income market, around trade, I think, some of that has passed. I mean, a lot of that, as you know, I think was just sort of portfolio rebalancing, not really this kind of sell America trade. And it's encouraging to see the fixed income market kind of settle down over the last week or so.
Yeah, certainly. I would agree 100%. I mean, it's going to be very, very hard for this super tanker of the U.S. economy to suddenly become out of favor on a more permanent basis with the rest of the world. I mean, in terms of entrepreneurialism, in terms of regulation, in terms of the deep capital markets, believe it or not, still the rule of law. There's a lot.
There's also many ways of taking it, right, Jeff? I mean, it's not that we're trying to cut I mean, you could argue maybe on one side of it, right? This goes back to the uncertainty. We're trying to wall ourselves off from global trade. At the other side of it, we're trying to integrate ourselves more with everyone else, except for China, right? So if you're an investor, are you really going to punt the dollar and like America because to me, I'd love to hear what Steve thinks. I think the most genuinely good piece of information that's come out in the last week has been the progress that they're making with India. Okay. And I say that not because of, I have family there. I'm saying that because it's a few dimensions, right? Number one is economic, obviously. I mean, you have a burgeoning middle class, a growing consumer market. That's obvious. Number two is the national security element. The Indians talk all day long about how the Chinese encroach on their territory. So so you have a very large economy with a large population, with a large military to act as a check on China. And then the third, which I think is the most politically relevant, it really undercuts one of the arguments that Trump's political rivals make about these trade deals. What's the main argument they make? He's not getting us anything new. Like, what's the point of doing a deal with South Korea? We already have a deal with them. What's the point? It's NAFTA 2.0. It's just like he's going to call it USMCA, even though it's really just NAFTA. Like, that is their big argument. Well, guess what? If you do it with India first, that argument's doesn't hold because we don't have anything with India in any meaningful sense. There is no trade agreement with India. So to me, to your point, are we walling ourselves off from the global economy? That may be one way of looking at it, but or are we trying to integrate ourselves more with everyone and wall another country off?
Yeah, I would just add two things, Neil. The Economist for this week had a really interesting feature specifically on India. I encourage those who have access to check it out. But I would just add to what Neil said. One, It does provide additional market access to a large and growing economy. Unlike China, we got the demographic issue; they're declining because India has a lot of tariffs on our products, and that's one of the things that they seem to be willing to adjust. I think Neil made a good case for a lot of the geopolitical reasons it would make sense not only for the U.S. but for India to have a closer alliance with the U.S. The only thing I would add to that is India's, I believe, the eye in the BRICS sort of group of countries. And so to have an important alliance with the U.S. to keep a check on those aligned with China, Russia, Brazil, I think Iran's now a member. I think that's really important. We talk about Trump's concern about de-dollarized trade in particular. So yeah, I think Neil's laying out the bull case for this, which is something that I think the Trump administration hopes to achieve. Whether they will or not, I think remains an outstanding question. But it's about reducing tariff and non-tariff barriers and to expand U.S. market access for countries beyond China. And then whether the U.S. can get other trading partners to come along and ratchet up their pressure on China to try to isolate China, I think again remains to be seen. But yeah, that's sort of I believe the administration's ultimate goal.
Look, the bottom line is the capital will go where it's best treated, and there's just no way that the U.S. has somehow magically lost its allure, right? I mean, at the margin, these things shift all the time, but are you really going to tell me that you want to put your money elsewhere, like in a substantially meaningful way? It just doesn't.
Well, there's a distinction between wanting the dollar to, like when you say we want to have a strong dollar policy, like that means different things to different people. To me, it basically means they want to have the reserve currency. They're not trying to give that up. What they want to see is growth expectations rising in other places, so the dollar is a little weaker. I mean, basically, it takes some of the pressure off of, the U.S. as being the sort of like consumer, like purchaser of last resort. I mean, that's kind of what they're trying to. I mean, it's just, it's like I don't think those two things are necessarily in tension.
Yeah. What do we have for data next week, Neil?
Big week. I earned my paycheck next week. We got ISM. We'll see how that looks because obviously one of the ironies of this trade stuff is that it's meant to help domestic manufacturing. We've gone from wanting to help domestic manufacturing to talking about how much rice and soy we're going to export to the Japanese. But at any rate, ISM manufacturing is coming out next week. So that'll be important. But as I say, like the manufacturing sector is feeling it right now because they're having difficulty sourcing inputs for a lot of the end assembly that happens domestically. And then it'll be Jobs Day on Friday. We got a lot of stuff on the labor market actually next week. Not only do we get the payroll number for April, it's probably a little bit too soon to talk about a big effect, but I mean, stranger things have happened. I mean, if things are frozen in place, you could see a big drop in the hiring rate. But we also get employment cost index and like the labor turnover survey. So like job openings, quits. So that'll be also something to keep an eye on.
Steve, what's happening in DC?
Well, a little bit before, but just to reiterate, Congress returning, Republicans focusing on the contents of that reconciliation bill, and then whether we're not going to get that X date from the Treasury Department.
Well, in terms of markets, that 5,500 number looms large. Still looking for more of a reversion from the beta trade. So beta has been just absolutely obliterated here. Expecting that some of that starts to come back. We have seen a little bit of that, but again, from the 0th percentile where we are today into something that is more accommodating, probably something closer to the, call it 30th percentile or so in terms of returns. But beta is certainly underweight in portfolios right now, and we think that is likely to be a mistake as we look out the next 4 to 6 months. Join us again next week. We'll be 1 week older, 1 week wiser. I'll be back in New York, Connecticut, the East Coast, whatever that is. Don't forget to follow us on Twitter and YouTube. You can subscribe to that channel as well. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.